Hi guys, 24th of July, Monday, MAO with Kel once again. Now, Tom Lee from Fundstrat is expecting the FAANG stock to book profit soon. And in fact, he says something even more interesting. He says that the FAANG stocks buyers may not come back in again. Now, this is very interesting because to me itself, I also believe in what he said, and I think that I agree. So let's just see what he shared on CNBC. It's going to be very, very interesting. All right, before that itself, disclaimer apply as usual. Thank you, Ames, for the kind sponsorship. All right, so remember what I said last time on MAO. I said that we probably going to see a market peak very soon, all right? And I gave the specific timing. It should be from 20th to 25th of July. I mean, we are going to see a peak somewhere around here for the NASDAQ and the S&P too, and we are actually probably seeing that. And interestingly, it's all right, the retail money is still entering the market, but the institutionals are actually coming out. Oh, this is going to be very interesting because we all know that once the institutions get out of the market, right, this is going to be very interesting. And of course, you won't want to hold when the boys are actually selling, right? So this is something to take note, and this is something I shared last week. And of course, right now, you can see over here itself, the, oops, some PowerPoint issue, just give me a moment. Okay, where are we? Okay, moment, yeah. Sorry for this. Oh gosh, okay. Here we go. All right, so let's take a look what happened on last Friday, shall we? Last Friday. Okay, so last Friday, we can see that the market is behaving this way. The Dow Jones up by 2.51 points, less than 3 points. It's very interesting, but it still managed to consecutively be in upside there. But the NASDAQ pulled back by 40 points and the S&P up by 1.49. So basically, right, Microsoft was down by 0.89%, but Google was up by 0.69. Meta was down. Apple was down. Nvidia was down, right? Amazon was pretty flat, and Tesla down by 1.1%. So the main thing is what's happening. So Fundstrat Tom Lee came in and said that profit taking will be part of the investor mindset, which is natural because it's profit taking, right? And particularly those who enjoy the stupendous year-to-date return from the tech and the FAANG counters, okay? But that doesn't mean that when they take profit, they have to necessarily exit the market. That is totally true. And he feels that right now, right, we might have a potential more of a dovish pause, okay, dovish pause. So of course, that means that the investors may find that maybe it's time to look at other counters. They may not be coming back to the FAANG counters. They may stick with some tech, but not, they may broaden out to the industrial and financial. So this is interesting. So let us bring this Tom Lee to the picture and hear it for yourself. Let's bring Tom Lee now from CNBC. All right, let's go, Tom Lee.
Fed decision. Something in your notes, though, I mean, made me raise an eyebrow. You say we also have to recognize stocks have advanced sharply in the past month, so profit taking is healthy. Tom, profit taking is healthy here?
Yeah, I think profit taking is healthy because I think that's going to be part of the investor mindset. You know, investors who've been involved with tech and FAANG are enjoying pretty stupendous returns year to date. Now, it doesn't mean that when they take profits, they have to necessarily exit the market. But to me, next week is a story of, well, if the Fed surprises us in a way because it's more of a dovish pause, I think investors are going to look for ways to sort of find stocks that rise on easing financial conditions. And they may not come back to the FAANG. They might stick with tech, but they might broaden out into industrials and financials. So yes, profit taking, but doesn't mean the market has to go down.
And to your point, I mean, we did see the NASDAQ take a breather today. We did see some of those big tech, and this week, the big cap tech names in general sell off, in part because of earnings over the last couple of days with Netflix and Tesla, this rotation. One of the other questions that's getting raised right now is if we're overbought and we're due for a pullback or even a correction. Your thoughts?
I mean, the market's definitely overbought. You know, we're 13% above the 200-day moving average. In the past, that's a sign of a strong market, but it is also a market that's vulnerable to bad news. So I'm kind of sympathetic to the view that there are signs of a correction. That's what Mark Newton, our technician, wants us to be alert to. But on the flip side, I think there are too many who are quickly calling this a top, and that puts me in the camp that we might, whatever weakness we have, may end up proving to be shallow, especially given we have a huge FOMC inflation. We have many conversations with our institutional investor clients, and they talk about how inflation is going to be sticky because of wages, and it might stick at 4% for far longer. But we're finding the glide path to core inflation and core PCE, could actually undershoot what a lot of people think over the next few months. And so I think that's one of the upside stories, that as soon as inflation softens at that pace, Fed officials themselves can actually start to breathe easier. And I think it causes many investors to rethink higher for longer.
All right, so apology for some background voice because of the internet going down. But more important is that Tom Lee is actually saying whatever he feels. So that means that he's saying that the profit taking will come in, but it'll be shallow. Now, personally, I agree. One point is that he says that the NASDAQ now is above 13% of the MA200, sorry. And my S&P now is basically up by 11% above the MA200. So that's the reason why I'm calling for sell since last week. And I think that a pullback of 5% to even 11% is actually very possible. So that's the reason why we can see that Tesla came off yesterday on Friday, came off from the high of about 300 all the way down to 262. Now there is a very good chance to see Tesla going down further to test the 240 mark, all right? This is a level that I think Tesla could be hitting first. Now, at that moment, we hit 240, we may see some buying coming in because we all know that the retail have been buying a lot of Tesla recently. But of course, Tesla came down is primarily because they are worried of the earnings. Now, I did say that, right, because the margin concern, because when Tesla bring down prices to be competitive, and with the commodity prices increasing, that the chips are increasing in prices, so the margin is a big concern. And of course, if margin is a main driver for stocks, then of course, with the margin reduced, right, it may not be as good for the stock upside. Yeah. All right. So take a look at this one here. So this is a very interesting chart between the COVID crypto boom and of course versus the AI boom. So we noticed that right, NVIDIA is moving in a way quite similarly. And of course, by right, if it's going to happen, then by July itself, right, we may see some profit taking. And this is something that it can actually happen, right? So the question is, will NVIDIA be doing the same thing again because of the AI following what happened, the crypto and COVID boom? Well, if it's going to be really superimposing itself, then a pullback to about $300 is all possible for NVIDIA. Now, one thing is that the US labor market is still pretty tight. We all know that unemployment data have been still pretty strong, but the housing market slump continue, and this is not a good sign, and this could actually weigh on to the economy. Now, one thing is that Warren Buffett has sold many of his TSMC shares, I think early this year, and the reason is because most of it is geopolitical. But the thing is this, it's interesting to know that TSMC has reported their first profit drop in 4 years as electronic demand slump continue. Now, this actually is very interesting. And of course, this tells you that, right, even though now we have the AI frenzy going on, that's positive for TSMC, but it's not enough to offset global macroeconomic headwinds. And that is very, very important. And one thing for China is that we saw this report coming out that many analysts are actually revising their GDP forecast for China. And the thing is this has been dropping quite, I mean, every revise is actually dropping down. And that's the reason why, although we are bullish in gold, bullish in the crude oil and China, but we did say about China itself, we need for it to drop one more round, then it's a good time to buy, but not now, yeah? Now, excuse me for that. Now, one thing to note is that the NASDAQ basically is, excuse me, my bad. Well, NASDAQ has basically reshuffled, as we know, all right? And very interesting, we have a very big option market expiring on last Friday, but if you look at the chart itself, right, it hardly budged. This is something that's not usual. And the only reason to explain this is probably the numbers of buyers and the sellers basically knock off each other. And this actually is a very important turning point for the market. So that's the reason why I think that traders, you need to be very careful on this, because the Conference Board, right, basically the leading economic indicator shows that we are now really at the -10 level, very nearby. And every time we hit this -10 level or this range itself, right, you can see we will get to see a recession, guys. This is not something that we are not going to lie about. It's from 1970, okay, from here itself, guys, from here, you can see that every time when this happens, a recession will definitely be very nearby. And of course, one thing to note, we notice that there's a very interesting pattern, is that before recession comes in, right, technology companies will have to trade lower, and that's because of the rising interest rate. So right now we have the rising interest rate. Right now we have tech stock doing pretty well. And if earnings data are all coming in, then probably right, we're going to see something repeating on its own. Don't you think so? So that's the reason why now you can see that retail investors has splurged in $3.9 billion on cash equity last week, just from JP Morgan. Yeah. Well, they have been buying a lot of Tesla, Apple, and Nvidia. Okay, they've been buying a lot because it dominated the 1.3 billion inflow. But the thing is this, if these retailers are buying right, then we have a problem here, because look at it, this is where the main price they bought in last 2 weeks, and the market is near the peak. So if you ask me, it's all right. If the market go down by another 5 to 10%, then all these retailers will start to cut their losses, and the boys will be buying, as what Tom Lee says, right? They could be buying at the bottom. So guys, that's the reason why we do not want to chase counter. In fact itself, this is a good time to take some profit. Don't you think so? Now, one thing is that, right, the CPI data, now there's an interesting thing from this Bank of America. They are actually saying that, right, from July onwards, this CPI data might be going back up. And that's something that I also said. In fact itself, I'm having a preview coming this Saturday to talk about this second wave inflation. And what will happen naturally, that will cause some equity selling. But what can we do with that? We can take advantage of this to make some buy position later on. Because now, right, 80% of the S&P 500 equity cap will report by the August 7th. That means that by August 7th, right, more than 80% of the company will have reported their earnings. Hence, therefore, in the later part of the week, later part of August, right, likely the market is on its own. And usually, if the earnings are not fantastic, there will be some profit taking coming in. So now, if you look at what happened in 1928 inversion that predicted the Great Depression, you can see that, right, every time when this phenomenon happened, whereby the 10 and 1 year spread goes down, there will be some selling on the Dow Jones. You can see it right here. So if you look at the screen, this is where it happened. When it get this point here, you can see the Dow Jones will start to come down on the recession node, right? Okay. So with this understanding right now, you can see that what is happening now is the same. We have a very deep spread difference, while the Dow is still at a high point. So it's just a matter of time if this is going to continue, right? If you look at the chart right now, I cut it across, you can see that, right? It's just a matter of time the US equity market will actually pull back in the near term. So that's the reason why right now we should be very, very careful, because this could actually brings down the market. Now, of course, we don't expect a major crash, like, you know, like down to 20,000, but I think that from where we are right now, down by another 10% is actually mathematically very, very possible. So I'm going to put there minus 10% from where we are right now. But of course, again, at the moment, the market strength is still there. So wait for the signal to enter. That will be the right thing to do. Now, if you look at what happened in 1928 versus now, the 10-year and the 3-month treasury yield spread, you can see that it's a very clear indication that it's repeating and repeating. So we saw it happen in 1928. We saw it happen in 1976. We saw it happen in 1983, 82, right? So all these things shows that we are going to see a recession. So that's the reason why now there's going to be some profit taking, and the boys probably didn't know this, and they know that it's time to get out from the market while the retailers are jumping in. So what do you think, guys? Let me know in the comment box. Yeah. And the thing is this, with that itself, right, we can see consumers has 2.5 trillion in excess saving in 2022, but recently itself, this number has flattened, because why? There's no more free money going in the market. And when that is happening itself, right, you should understand this, that the tech bubble usually bursts, okay, before the recession. So all these things shows us that, right, this could actually be happening. And of course, guys, if you don't want to be caught on this, it's time to be careful, because things can just repeat on its own. And of course, we have been calling for this for sell. We want you to be careful, because we believe that now the second inflation wave is going to start very soon. Now, based on what happened in 1970s, we have seen the triple wave that created a hyperinflation. And to us, I think they're going to see this happen, because if the Federal Reserve is a cut or pivot the rates, right, naturally the US dollar will basically go down lower, and that will cause prices to go higher because of US dollars. And of course, when this is going to happen as well, right, what will naturally happen is that prices will shoot up faster. You may have some increase on value, but then again, when people cannot pay for it, the purchasing power reduce, then things can get very bad. And that's the reason why we want you to join my preview. Is coming 29th of July. Quickly sign over here yourself, and you put in your data, and we'll tell you what to do, and you'll see our Zoom ID coming up on the Friday, so you can join on Saturday. All right, this is a prelude for our 23rd intake, right, coming in August. Okay, all right, hope you enjoyed this video. This is Cal signing off. Take care and do your best for trading. Bye-bye.